For those that are here for the CE credits, just bear with me to the end of the presentation. I will email you afterwards, get your CE credit info. Submit it to the CFP board. So just hold on. Don't just leave right away. If you happen to be in an office and you're a financial advisor and with other financial advisors, please let them know that this webinar is taking place. I promise you will enjoy it because Meb Faber is one of the OGs in the industry who I've known for well over a decade, who's built a hell of a company with Cambria, a number of funds, and we talked about some of those, as well as 351 exchanges, which Meb believes are going to be the next hot thing in all of 2026. So you'll get a good insight on that process. And with all that said, my name is Michael Gayed. This webinar is sponsored by Cambria, one of my clients. I will introduce my friend, Mr. Meb Faber, and you will all be wowed, I promise you.
What's up, everybody? Happy Wednesday. I should be wearing my Dodgers hat, but it's Dodgers blue. So I'm a reform Rockies fan. So if anyone's cheering for baseball, I'm Rockies are basically a AA team at this point. So anyway, I got a little deck that we can run through that'll be fun if as everyone kind of joins in here. What are we talking about today? This is a topic that probably 99% of advisors, investors, VCs, CEOs have not heard of. And this is the topic of 351 ETF conversions. And we'll talk about a few things as we go along here, of course. But, for those who don't know us, my day job is running Cambria ETFs, where you can find a bunch of information on our 19, soon to be 20 funds at cambriafunds.com. We have a little over 3 billion and 100,000 investors. We have a really nice free research website called the Idea Farm that's getting redesigned. It should be out this week. Pretty excited. It should be your institutional research homepage. It sends out an email once a week, also to over 100,000 people. We've been publishing blogs and research, white papers, books for a long time over at Meb Faber, and then more recently on the podcast. 600 episodes now, which I can't believe. Guy's an alum as well. But as we talk about what's going on in the world, we'll do just a quick update. Everybody's fat and happy. There's two kind of topics that everyone's talking about right now. That's stocks at all-time highs and gold. Nobody was talking about gold when it was 3,000. Now everybody's talking about it at 4,000. There were signs. This is a chart of the U.S. valuation, and we're back up to, I don't know if you can quite see it because this is updated in June, but we've now exceeded that little peak in 21. So the final boss is left on a PE ratio basis. This is the most expensive market since late 90s. A little different. The companies have been growing. They have some cash, but still they're expensive. I learned yesterday that the top 9 stocks in S&P and NASDAQ are all the same names. I feel like that would surprise people. It would be the top 10, but Berkshire is not in the NASDAQ. So everyone knows you got this valuation problem, you got this concentration problem. I feel like these are well-known topics, but everyone that you talk to say, look, I bought NVIDIA, I got the Mag 7, I got Apple, I got Berkshire, all these stocks, the U.S. stocks in general, SPY, and they say, well, I can't sell them. I know they're expensive. I want to sell them, but Taxman's going to kill me. And so you have these two options. If you got concentrated stock holdings, you just hold it and just suck it up. Say, look, I'm just going to deal with this over time. I can sit through drawdowns, or you got to sell it, pay those capital gains taxes. No one likes to pay to the government what, or the tax man, right? Like no one volunteers to pay more than they owe. So you sell, trigger capital gains, and move on. But what if there was a third way? This almost sounds like a 8-minute abs sort of conversation, but we think we have found a good solution to this and other problems that are similar. So let's think about it. How are we going to do this? Well, the answer we think is 351 ETF exchange. And for those who aren't familiar with that acronym, it's sort of like a 1031 real estate, but for stocks. So it's a contribution that allows for the transfer of assets, such as stocks or ETFs, but really it's public assets, stocks or ETFs, to an ETF without realizing a taxable event. Now, it's not washing those taxes. That would be illegal, of course. But basically, you're contributing property to an ETF, getting the ETF in return. And so why is that interesting? Well, you could move from a very concentrated portfolio to a diversified portfolio. And then if you know anything about ETFs, the ETF can then rebalance and stay diversified for the foreseeable future. most ETFs really never pay a capital gains distribution. So what are the main rules? Where are we here? Why isn't this moving over? There we go. There's two big rules. First of all, you can't just give me 10 million NVIDIA. The biggest position can't be above 25%. And then second, the top 5 positions can't be above 50. So realistically, what does that mean? Well, you need about a dozen stocks, or ETFs are pass-through. So SPY, for example, is a pass-through security where it looks at the underlying holdings. So theoretically, you could actually contribute 100% SPY. What do people do in reality? Well, they tend to submit a little bit of both. So they may have a handful of concentrated stocks that they would like to move on from, and then round it out with some ETFs as well. This is only on the seed, so you can't do this after an ETF launches. Once an ETF launches, it's just like every other ETF. So if you want the 351 benefit, you got to do it at the beginning. So again, like a lot of people ask us these questions, and they're typical of things that qualify and don't qualify. We just mentioned you can contribute stock, and various numbers. Anything above really a dozen is usually good to go. You could do things like ETFs, things that don't qualify. Anything private, options, futures. You can't do 50% NVIDIA and 50% cash. You can't do mutual funds. Can't do Dogecoin. All these things. Although, by the way, I think you will be able to do next year contributions into 351 from various crypto positions if the underlying strategy, the ETF, has crypto as a part of the overall portfolio. So I'm going to skip over the next fund we're doing, and I'm going to jump real quick to the funds we've done. So we've done 3 of these already. First one was almost a year ago, and kind of announcing it to the world. And as you can see, as they've been getting bigger and bigger. Tax was 30 million-ish on launch, which is a U.S. stock fund avoiding dividends, targeting companies with low payouts. ENDW was a diversified allocation fund using a little bit of leverage that launched with over 100 million. I think it's over 125 now. And then GEW launched a couple of weeks ago, and that one was 150 million. So they're getting bigger and bigger. That was a global stock fund. So what's the next one? Well, we got USEW as the ticker, and that's going to focus on U.S. stocks. So looking at U.S. stocks as a percentage of the whole, this concentration issue. So we're really trying to break that market cap link. Market cap to us is a dangerous place to be. Currently, historically, market cap has underperformed equal weight over long periods, although over other periods, like the last 15 years, market cap stomps everything else. And if you look at the equal weight, type of idea, we can accept any type of U.S. stocks to be the biggest and the most liquid. But more importantly, this is a fund that's coming in at a very low expense ratio of only 25 basis points. Pretty screaming cheap. This launches December 17th. So what do you got to do before then if you're interested? Everybody's quiet. No chat, no questions yet. So you guys throw these in if you got any questions. What are the dates here? The dates are, you got to let us know now. There's 2 options. You got to go through a financial advisor. So you let us know, hey, I got some clients. They're doing direct indexing. They got concentrated portfolios. I want to do a strategic rebalance, whatever it may be. I want to indicate my interest. So we'll help you. We'll give you white glove service, walk you through, kind of go about contributing here. And you got to have these portfolios in by the week before Thanksgiving. So November 19th, you got about a month and a half, plenty of time. And all the paperwork buttoned down by essentially Thanksgiving. And then this will launch mid-December. If you're an individual, if you're a family office or something, we have the ability to work with various RIAs or people that can upload these, that can walk you through the process. Reach out to us. Certainly, we can help you. This email is golden351@cambriafunds.com. You can also go to the website. It's got a ton of information, cambriafunds.com, about our ETFs currently, but also the 351, a lot of PDFs, a lot of podcasts that'll go into a lot deeper discussion on what we talked about today. I'm giving you guys a very quick overview because everyone's so quiet. No chat, no questions yet. So we're kind of just cruising through. Chat's disabled. Well, just kidding. Throw it into the Q&A then. Sorry, you guys. If you got questions, put it in the Q&A, not the chat. Q&A. Thank you, Kimberly. So if anybody's got questions, Q&A. So as of now, I'm going to kind of start to wind down a little bit on this very, very quick overview. Hopefully I didn't skip over too much because we've done this so many times, talked about it, that it's second nature to us. One traditional question for people is often, hey, look, Meb, I'm busy. It's year end. Will you be doing any more of these in 2026? I expect this one to be our biggest yet. So likely in the hundreds of millions of dollars. I don't think it'll be over $1 billion, but it could be. But we plan to lay out a buffet of a few more choices in 2026 with onboarding maybe at the end of Q1, into Q3, Q4, various strategies. I imagine a U.S. stock, a global stock, and an allocation will probably be the traditional buffet for next year as well. You can come see us in Los Angeles. We're located here in Manhattan Beach. And again, here's the website and information on the email to be able to reach out if you guys want to talk. I don't see anything in the Q&A. Oh, we got something. What securities can we take? You know, a lot of people who have experience with traditional exchange funds have had a sour experience because let's say you got 10 million NVIDIA and you reach out to Goldman or Eaton Vance and they're probably charging you an arm and a leg anyway. But traditionally, the problem with exchange fund is A, you got to hold it for 7 years. B, it's expensive. C, if you got NVIDIA, they probably aren't going to take it because they say that's all anybody's got is NVIDIA. And so, you know, they for, at least for us, if it's some tiny micro cap mining stock, you know, from Vancouver, we probably won't take it. The basic rules are, is it liquid and tradable? And then does it match the strategy? So the next fund in December is U.S. stocks. So we won't be taking any foreign stocks. We won't be taking any real estate or commodities or anything like that. It's just a stock fund. But with that understanding, almost all stocks qualify. It just can't be tiny and it can't be something that's not liquid or tradable.
Can we get a little bit into the mechanics, like in terms of now that you've done a few of these, how long is the process for an advisor? How involved is the end clients? Like, what does that look like logistically?
Yeah, I mean, it's pretty smooth. You know, traditionally for the clients, certain custodians are much easier. Someone like a Schwab is totally on board. They love it. Others like Fidelity, it's not like a universal experience. You know, you tend to have to go through your local administrator, product manager versus Schwab, which is just like a rubber stamp sort of situation. But even then, it's pretty smooth. We work with our partners, ETF Architect, Wes Gray and Pat Cleary on this. And so they got that military efficiency. They've done a bunch of these and we've done 3. So basically, you have to submit an Excel sheet that's got the client positions. And so, hey, look, here's the tax lots. Here's the cost basis. Here's, you know, basically a monthly report from Schwab. And we make sure that it qualifies. And assuming it does, then you need to sign, you know, one form, client, hey, I know that this is happening. This is going on. I get it. And basically we say stop trading. So end of November, we would be like, stop trading this account. You know, you can't have margin or shorts or leverage on it. And basically, you know, a couple days before, those positions will transfer to US Bank. And then the day of the launch, you'll get the ETF back. Now, the cool part is, let's say you submit 20 positions, you're going to get the 20 positions with an original cost basis for the ETF. And so you can kind of pick and choose what cost basis you want to trade in the future. So there's no holding period. You could theoretically sell it day one. Now, you're not going to want to if you contributed NVIDIA at $1 because you're going to be paying taxes on that original cost basis. But if you contribute NVIDIA and maybe some SPY that doesn't have as much of gains on it, the SPY could be liquidated pretty quickly, and you may not have to pay significant taxes on this. So it's a pretty flexible approach. We have people that have submitted direct indexing long-only portfolios that may have 100 or 500 positions, and then they now have all these tax lots on the ETF that they can manage going forward. And so there's some people also that say, hey, look, you know, there's like 4 main use cases. The first is concentrated stock. The second is strategic rebalancing. So if you're stuck in all U.S. stocks, for example, market cap weight, and you're like, I just got to get out of this SPY or the Qs. And then third would be something like a direct indexing. Fourth, though, if your financial advisor is business development and prospecting. I mean, I can't tell you guys, I say this, you guys now know about it, but zero VCs I've spoken to. So despite the fact their entire business model is to invest in private companies that go public and distribute these massively appreciated shares, they usually then just sell them. Well, if you're rich enough, you'll just donate them. I don't know. But again, you could easily contribute these and get a diversified portfolio in exchange. And so it's there's a lot of different use cases. None of the companies, like if I was a local financial advisor, I'd go down to my top 5 biggest public corporations and say, can I talk to your investor relations? I now have a solution for your 10,000 NVIDIA employees that have like $20 million stuck in this stock. We can be able to assist them in a way that will help them to start to diversify away from this company. So I think it's a pretty interesting idea that has not gone mainstream yet. I think 2026 will probably be the year of the 351.
You mentioned, let's talk macro for a few minutes here. You mentioned everyone's fat and happy. I'm pretty sure fat and happy often leads to the conditions under which heart attacks happen. So obesity is a legit cause there. Are we ever going to see risk again, man? I mean,
yeah. So, I've said a couple of things. We wrote this paper, which I loved, my favorite paper of the last few years, which is called The Bear Market and Diversification, just talking about how the S&P has crushed everything for the past 15 years. And then over the last year or two, you've started to see other things perk up. So there's the one that's everyone's talking about this year, which is gold, and rightfully so, and silver. Those things are up, a ton at all-time highs. But then you have some other things, and I said this today kind of quietly beneath the surface. So everyone, I had a tweet when gold hit 3,000. I was like, gold's ripping. No one in my world's talking about it yet. And so today we were like, gold's ripping. It's at 4,000. Seemingly everyone's talking about it now. But with U.S. stocks at all-time highs, there's some other things that are doing great. Foreign stocks, the value trade, has been fantastic ex-U.S. this year. So a deep value strategy is up. We have an ETF GVal, which is up well over 40% this year. And I'm going to tell you something. It's October, so it's Halloween, Gayad. I'm going to give you a spooky statistic where currently that fund, and you guys got to look it up, but certainly this month over the next few weeks, unless it crashes or goes down, I think this is a statistic that will surprise everyone listening. This GVal ETF, which buys the cheapest countries in the world, so often places many people don't want to invest in, for many years was totally stinky. This strategy buys countries like Brazilian stocks and Colombian stocks and Polish stocks and Turkish stocks. UK stocks was in there for quite a while. This fund is now beating the S&P on a 1, a 3, and a 5-year basis. And people are like, oh my God, that can't be true, right? Like US is creaming everything. And, the challenge is some things are starting to really, come around. So that having been said, there are other areas that have not started coming around. I think the ones that are going to be most obvious to people would be US mid cap, US small cap, US value, right? Those are doing okay, but you haven't seen the reversion the same way you have ex-US value. And broad foreign developed and emerging are doing great too. I think, those are in the kind of 20, 30% range, whatever they are. Those are doing well. But until the US market cap weight does something else, so it could be sideways, it could be down a lot, I don't think anyone's motivated to move. If we know anything about inertia, people, when they're fat and happy, they don't want to get off the couch. So, but if something starts to jiggle or things get a little weird, you could see some pretty big shifts. We said the other day on Twitter, it was a valuation chart of market cap versus equal weight. I said, to me, you have to be crazy to be YOLOing into market cap weight. If you're a strategic asset allocator doing this for the next 10 years, if you're a trader and you're trading, whatever, that's a different story. But if you're an investor, I think this point in the cycle, historically from 40 plus CAPE ratio, we have not found a time in history where a country stock market ended the year. So we're not there yet. We got 3 months to go. But if we end the year above 40, there's been no year in history we could find where the future 10-year real returns are above average. So meaning like 5% real returns. And on average, it's zero real returns for the next 10 years. So not the best starting point, but as a trend follower, I'm happily long everything just about, but it's on the value side, it's getting a little scary.
I reposted and liked, as you could tell, this post from you.
That was a good one.
Yeah, what's coming next? You said bear market.
Yeah. Well, I've had a lot of fun with AI. I downloaded Sora. I've been poking my favorite nemesis of CalPERS and other institutional managers. I posted a video to LinkedIn. I posted a few commercials for our ETFs, but my compliance friend said, you got to take these down, Meb. Even though they're AI and even though you're joking, you can't even mention it. So I said, okay, I'll turn my attention to CalPERS. But I posted a video of me presenting to the CalPERS board, but the CalPERS board was replaced with Lego figures. And they all started crying when I said I was going to fire everyone and replace you guys with a bunch of ETFs. So I'm having a lot of fun with AI, but it seemingly is sucking all of the air. I saw I do a lot of startup private investing. I saw a stat the other day that something like 70% of all the money in deals are going to AI companies, which jives with my deal flow that I see. I see it's all AI companies that are either have no revenue or are trading at crazy valuation, or have some revenue and are trading at crazy valuation. Either way, it's crazy valuations across the board.
I guess the question is, can you have a bear market in AI and bull market and everything else?
It's interesting. Even the stuff that's in like the NASDAQ Qs that's not tech is getting dragged up, like Costco. And I love Costco, but it's something like a 50 PE. It's like a nutty time. But again, it feels like, right? It feels like musical chairs right now. It feels like everyone knows. Like, it's not like people are like, no, stocks aren't expensive. I was like, everyone's like, yeah, okay, this feels nutty, but I gotta wait. Like, I'm going to be the first one to jump off the Titanic. So I think there's certainly a lot of things people could be doing to diversify away from market cap U.S. stocks, but I don't think anyone is quite yet.
Yeah. Let's go back. And again, for those right here for the C credits, I'll email you afterwards. Go back to the 351s. For advisors that are curious and want to do it, how would you advise them to go about talking about it to their own clients? Because it's kind of a concept, right? I mean, there's an education process both ways. You on the advisor. High net worth.
The first thing is just go to the Cambria Fund site. We got a 351 tab. There's a bunch of PDFs and podcasts that are pretty good material. Gives you a broad overview. I mean, I think the simplest way is to describe it as, hey, look, having a concentrated portfolio, and there's reams of research on this, is a horrible idea on average. You'll always get the exceptions where you can point to someone and say, well, look, but they've owned their entire portfolio has been in Berkshire for 30 years. Their entire portfolio has been in NVIDIA. And you're like, well, but thousands of other stocks where their entire portfolio was in X and it lost all their money or underperformed. So it's even harder for individuals, particularly when they have a concentrated portfolio that made a lot of money, because then they have that hindsight bias where like, this was my ticket. I know this company. I know Enron is the best place to be, on and on. So I think the way, if the client's on board, say, okay, yes, I realize I needed to diversify. I'm on board. That's sound advice. I don't want to put all my eggs in this basket. It's kind of like saying, hey, if they know what a 1031 is, say basically you can swap this building out, sell it, you get another building and defer your taxes. I think that's the best analogy. It's not a clean one. If they've experienced exchange funds, it's not that too different. But basically it's like, hey, you can swap out this portfolio, get this other portfolio. And then 351's been in the tax code for many decades. It just found its perfect partner with the ETF structure. And so, you've seen a lot of prior art. There's been over 100 of these now. So it's kind of the best way I would describe it is that you can diversify in a tax deferred manner and do it in a way that's clean with a lot of, when we were talking about this a year and a half ago, it was a little different because people were like, well, you haven't done any of these. Is this real? Is it legal? And now, like everyone's doing it, it's, Goldman did one that was $1 billion. But obviously only for one client. So we're one of the I think us and ETF Architect are really one of the few that are doing it open enrollment. Being like, if you're a financial advisor, you're an individual, reach out and we can help you out.
Oh, we got one more question. Want to do one more question? Hold on. Would you like to talk about how the Cambria ETF gets managed once launched and all the assets are mixed?
So thanks, Kimberly. It depends on what the strategy is. So for our next fund, it's a U.S. stock strategy. And it depends a little bit on what's contributed. So here's another example. You can go back and look at our old ones. So like our endowment ETF, ENDW. ENDW is meant to be broadly replicate endowment style allocation and uses leverage. So it gets up to 140% leverage. So if you look at that fund, it owns ETFs, it owns some treasury futures, but it had a lot of stocks that were contributed. There's sort of a glide path depending on what was contributed. We say it could take up to a year to get to the final portfolio. That having been said, we expect month one, week one, really because of what was contributed, and it's only under the universe that we're accepting, to really already be at a correlation, a beta to the final strategy well over 0.9. So already month one, you've got the beta of what the correlation of where we're going. And then over time, we're extremely conservative on, kind of not antagonizing the regulators. Others are not. They I think fly way too close to the sun on some of the ways they operate, not just this world, but in general. And so it will depend on each fund. So this one in December is U.S. only stocks, long only. But if you look for us as in 2026, we may have a totally different buffet of ideas, and you can kind of pick and choose which one you may be interested in.
It's probably a good place to wrap this webinar up, unless Web-Mib, you got anything else?
No, you guys please reach out to me. We have a lot of folks here that'll be happily set up a call, shoot you an email, talk about it later. And if you're in the local, you can come say hi.
There you go. Appreciate everybody that's here. You'll get an email from me shortly. Thank everybody for the attention, and we'll see you next time. Cheers, everybody.
Go Dodgers.